Just a couple items of business. I again want to thank Stocks and Commodities for hosting the event, helping us advertise it. A great sponsor. It's a magazine you should be registered to or you're subscribed to. I hope that you selected the free copy of the magazine when you're there, or when you logged in, when you registered for the seminar. Stocks and Commodities will be reaching out to you next week to kind of make sure they have the information that they need to send you your free copy. Also want you to let you know if you sign up for anything today, whether that's MetaStock or the training that Rob offers or anything like that, they're going to give you either a 5-month subscription to the magazine for free or $300. If you spend over $300, you're going to get a 2-year subscription. Stocks and Commodities is a great magazine, the industry standard when it comes to technical analysis. And I like the fact that everything that they do, every subscription that they have has every article that they've ever written as part of the web access. So a great resource. Definitely take advantage of that if you're not. It's important. By the way, we've won. MetaStock has won #1 in its price category for 24 years in a row. We're also, I know when we did the polling a little bit earlier, we've had a lot of people come in as you're waking up, but 24 years in a row, the readers have voted us the best. And if you want to get MetaStock on a free trial, you can. You just go to metastock.com/tradersummit-T. 2 T's on the end of that. T meaning trial. All right, so let's gear up for our next presenter. Price Headley is somebody that I've known in the market for a number of years. Definitely a very well-respected person out there. Somebody that I have to say that personally has had an impact on my own personal trading as well as my personal life. I love really Price's whole mentality around trading and that kind of stuff. He is a top 10 Market Timer. It is early. Market Timer Digest. He's won top 10 many times. The thing I think I like about Price so much, and Price is somebody that probably one of the first projects I took on this role. I said earlier today I really like being able to work with people that I feel are smarter than I am in the marketplace and know what they're doing. He's got like 20 years. He's written a lot of books. He knows what he's talking about. But I love his philosophy around trading. With 3,000 or 4,000 optionable stocks that are out there, you definitely want to step over the opportunities that are small opportunities to look for the larger opportunities. And I can't say it enough. I absolutely have a great amount of professional and personal respect for Price. And I'm happy that he decided to get up really early today and do our summit with us. So with that being said, I'm going to bring him out here and kind of turn the time over to him and let him talk.
Well, thank you, Jeff, and it's great to be with everybody. Price Headley here, and that's a very kind introduction, Jeff. Jeff has been instrumental in helping get our big trends information out to the MetaStock community, and that's what I'm going to be sharing with you today. Let me see that we can go ahead and share some slides with you here. There we go. Thank you, Jeff. Okay, so let's go ahead and share my PowerPoint here, the 7 essentials of trading. And let me make sure you can hear me okay. Type in what type of a trader you are. If you're trading day trading, swing trading, position trading, and if you're trading stocks, options, futures, just curious what kind of a crowd we have with us today. So we've got some day traders in here, some swing traders, futures, options, a lot of day and swing trading. That's great. So basically, what we're going to share with you today when we talk about the 7 essentials of trading, you can apply this to any time frame that you want. I'm all about keeping it simple. So we try to focus on really these essentials, these key components, and that's what we're going to talk about today. So, of course, at Big Trends, we have to remind you that everything we talk about here today is geared for your information and education only. Nothing that I share with you should be construed as a specific buy or sell recommendation today. Just consider it educational, that you start to lay some groundwork, so you start to train yourself about the right ways to trade. Ultimately, you know that you're solely responsible for your investment decisions. Here at Big Trends, we seek to be a resource to help you make better decisions in the heat of battle, and make sure you consult with your financial or tax advisor on any anything that could affect your unique financial and tax situation. Now, we're going to keep it simple today and focus on, the education piece, which is really getting you pointed in the right direction. If you're trying to hit the target, if you're pointing, off in the wrong direction, you've got no chance to hit the target unless you're Keanu Reeves in the Matrix or whatever, right? Bottom line is that, then from there, this is where you can use MetaStock. After you learn the principles that I'm going to share with you, you can use MetaStock to start exploring and narrowing your focus down to the top best of the best type of opportunities. And then it's about pulling the trigger, the execution piece. And we're going to tie in the psychology of trading for you today so you can kind of get to maybe what's been holding you back in some of your trading. If we're going to really blast your knowledge level off so that you can really make sure that you really have all the pieces of the puzzle. There's multiple pieces of the puzzle, and that's why it makes trading hard for most people. It's not just one thing that you have to master. If it was, it would be a lot easier, right? But that's the opportunity for you and for all of us to take our trading and our results to the next level when we start to nail down these critical points. So the 7 essentials I've laid out for you today, you've got to first know where you're going. You got to have some kind of a clear goal, and then ultimately a well-tested trading plan to get you there. It's like the old Yogi Berra-ism. If you don't know where you're going, any road will get you there, right? I don't think you want to follow that meandering path and just hope that you get to your goal. Bottom line is that then you're probably not going to get there. You're probably going to end up in some totally other area of town that you don't want to be in. You want to focus on the right path, and so that's what we're going to share with you is a path to get you there over time. And this is it's something that it takes time to master this stuff, but that, believe me, it's time well spent and well invested. Then you start. I'm a top-down guy. I start looking first at the overall assessment of the trend for the market. And then I start working into the individual stocks. Our prior presenter, Rob, mentioned stocks like Tesla. TSLA has been a phenomenal example of a stock that's been a classic blast off to the upside, and a lot of people have doubted it. And that's kind of the ideal pattern, because psychologically, a lot of people are fearful of stocks that have run up too far too fast. And in fact, what I'm going to show you is how you can hop on good trends where the structure is right, okay? And that's what we care about as a trend follower, is trend structure. If the structure of the market's not right, then you should hold off until you have the right setups, the right patterns for a better probability of success. Now, where even the brightest minds on Wall Street can really mess themselves up is not just on the psychology side, but also on the trade allocation, money management, how you allocate your money to each position. Because you've probably all been there. You probably had success at some point if you've been trading for a while. But then what happened to this is that success bred maybe an overconfidence. Maybe you got a little bit too cocky about your ability and said, then you can just, this is easy. I should have quit my other job a long time ago, right? Well, the bottom line is then you get too high on your recent success, and then you over allocate your capital, and what does the market do? Kind of like flying too close to the sun burns your wings, you fall back to earth. You get humbled. The market has a way of humbling even the brightest minds on Wall Street. You've seen a lot of very sharp guys that were managing billions of dollars, like the folks at Long-Term Capital Management back in the late 90s, that went belly up. Those folks almost took the financial system down with it. A great book called When Genius Failed is a great read on long-term capital management, how even the best and the brightest got themselves in deep trouble because they weren't following these proper principles of trading. And then for those of you who trade options, I know a lot of you do like myself, it's where I really put a lot of my energy, is you still then have to know the right option strategies, because again, you can be right on the underlying stock or market and still not get paid in the options market if you don't know the right strategies to use. So a lot of this goes back to knowing yourself. You've got to know what you want out of trading and out of life. If you define your goals, you've got a much better chance of A, reaching or exceeding your goals, and B, really being in tune with the right type of an approach. Let's face it, if you're a more conservative trader, I get a lot of people these days that tell me that they would just like more consistency. And I'm curious as we go into this, as we talk about these top couple of essentials, talk about essential number one, your goals. Just out of curiosity, I'm not going to share any individual names. So what would you say if you had a goal that popped off the top of your head of what you'd like to accomplish in your trading? What would you say would be at the top of your mind in terms of core goals? Is it you want to make bigger money? Is it you want greater consistency? Is it that you want to lose less if you've been losing? Is it that you want to, generate an income? Some of you say, okay, so we get a regular income, certain numbers, that people throw out as far as the type of game, but consistency are coming across very, very regularly. So that's become a greater and greater goal that as I talk to Big Trends coaching students, they're telling me, I want to have confidence in my trading again. I want to know that if I put a trade on, I may not hit a home run, but I'm also not going to get a strikeout, that I tighten up my risk and my reward so that it feels comfortable to make those trades. Obviously, every trade involves risk. I think a big part of staying in the game for the long haul is to have that clear, defined risk management, and we're going to talk about how I do it in my trend following techniques. So most all of you are saying regular consistency, a lot of income, supplementary income desires, and then confidence popping up as well. Want a good trading coach, Bobby? We can help you there too. But bottom line is, that the basic principle here is that, okay, we all know that trading involves risk, and so we're looking at how we manage that risk and be more consistent. So and then from there, you've got to get really specific. So we call it SMART goals. You've got to define a specific, measurable, attainable, relevant goal is timeline to you. So that's the SMART goal setting, is that it's got to be clear, specific. So how consistent do you want to be? How much upside, how much downside, what kind of winning percentage are you looking to achieve, et cetera, et cetera. We can then tailor make within options and within trading in general a strategy that can fit any given trader's goals and desires. But the bottom line is that there's always a trade-off. If you want to have greater consistency, for example, in options, you might do like an options credit spread program where you might, generate 80% or more winning trades. But then you better know how to manage the other 20% of trades when it's not doing what it's supposed to be doing, so that you don't get yourself to giving back those profits too quickly or too easily. Now, from there, it's about the second essential as well. Then, okay, you have your goal in mind. Now, what's the plan? How are you going to get there? And this little graphic, a very rudimentary one I put up there, is saying it's all about the better mousetrap, the light bulb, the better idea. You have to have in your trading some kind of an edge in order to, over time, be extracting money out of the markets from a very competitive marketplace. Let's face it, there's a lot of bright people that are trading the markets. Okay, there's a lot that also aren't so bright. So it's saying a lot that maybe think that they're smarter than they are. So you have to be able to define when you're good and when you're lucky, and know the difference. So don't base your system on luck. Base it on testing and base it on the kind of fundamentals that give you an edge. So we're going to share with you some of my edges, which are really developed around technical analysis. I'm a big believer in technical analysis because it's objective information about what all the buying and all the selling that's going on. Who's winning the war? Is it the bulls or the bears, or is nobody winning? It's going nowhere. So we're going to talk about all those scenarios. Obviously, over time, as you test this, if you're generating dollars, consistent income out of that, then you want to keep doing that and following your plan. If you're not, and I always say start small and then build. You don't want to ever go into anything too heavy at first. You want to prove it to yourself that it works, and then the beauty of trading is you can scale up your size over time, but always kind of ease into it. Now, when we talk about technicals, I know a lot of you are following the charts through MetaStock, and the bottom line is that, of course, technicals have been around for centuries, but I believe thanks to the computer and thanks to programs like MetaStock, you have so much more power at your fingertips. Like Jeff mentioned, we've got about 3,500 optionable stocks, about another 500 optionable ETFs and indexes, and so you're talking about literally just an overload of information flowing at you. You have to have a way to filter that. Thanks to computers and MetaStock, you can actually do that. Now, as a technician, I don't get hung up so much on the news. I want to be aware when things like earnings are coming into play, because if you're aware of that, you're not going to get blindsided. If you know that IBM has earnings next Wednesday after the close, well, then, you don't want to be in, options on IBM and then not be aware that the earnings are coming out and have a gap against you, right? But what we want to track after we see that initial response to the news, like earnings, is how that stock reacts to the news. How many times have you seen it where a company had quote unquote good earnings, but then it dropped once the earnings came out? This is very important to basically say, okay, let's make sure we're aware of if there's too much hype about a stock coming into earnings, if it's overloved, if everybody's buying call options. These are the kind of things we track at Big Trends, is what the general sentiment is towards the market. Frankly, the market's had a little correction here recently because we got a little bit too much optimism into the mix. We needed a little bit of a healthy cooling off of that overly optimistic greed, or sometimes greed can even be just a lack of fear. So I'll look at indicators like the VIX, the volatility index, to tell me where fear is, and it's been really low, but it's popped over the last couple of days finally. So we're finally getting some fear back in the equation if you look at the VIX, which is the options pricing for the S&P 500. Now, as a technical analyst, we know a few key things. The markets are going to be discounting mechanisms. They're discounting what's going to happen in the future because people are looking forward, usually in the neighborhood of about 6 to 9 months. So this is from the perspective of saying, okay, we have to focus. And I'm going to get into some charts, don't worry. So basically, I'm just laying some groundwork here first. I know a lot of you want to look at charts, but these are important principles first. That what we're looking for is, okay, when the markets discount, that you don't want to, that's why a lot of times stocks will fall after the news comes out. These trends are occurring even in front of that news, and so our job is to define that trend and how that's really kicking into gear. So from this perspective, we want to know how, since all of us are human beings that are reacting to certain emotions like fear and greed, that these trends, when they start going up, everybody wants to be a part of an uptrend, especially as it starts to be a pile-on effect. And that's where I'm going to share with you one of my favorite indicators, acceleration bands, here in a minute as we get into the technical side of trading. The bottom line is that we have to know when those trends are basically in effect, and also when they're maybe starting to end, where then we're getting a reversal of those trends. Everything that we're looking at as a trend follower and technical analyst is based on patterns of price action. The reason why you can see these patterns work again and again is because you go through cycles of buildups of optimism, and then breakdowns and busts where you get pessimism coming in and outright despondency sometimes, right? So you see these cycles repeat over and over. The names will change, the symbols will change, but the patterns tend to remain the same, And if they're not exactly the same, if they're not exactly the same day by day, they're certainly very, very close. And so we want to be able to see what other traders are doing. And so the basic principle here is that we're not going to focus on fundamentals per se. That's more important in the longer term. The main fundamental I would say that is important is earnings. I tend to look at earnings and say, let's make sure that the earnings are positively accelerating for an uptrend, or they're starting to see earnings misses in a downtrend. So that'll help you a lot as you come into the next quarterly earnings season. You don't want to buy a quote-unquote cheap stock and then just see it get cheaper. So the trend is very important. And so we're looking at price and volume trends, and we're saying, okay, from this, we can then focus on, okay, where we are and where we're likely to be headed. Obviously, no one has a perfect crystal ball, but you can give an edge to trends, that, especially powerful ones that are in place because of these patterns that tend to repeat. So we're going to use those patterns to help predict future movements. So when we talk about trends here, and so we're getting into the charts here in just a moment. Basic focus is we need to identify when is a trend really starting. The earlier we can get on that trend and the more potential that trend has to move, the longer we can stay with a potentially profitable trend. That's going to help us also as we start to look for what I call confirmation. We want to try to minimize the whipsaws. This is the thing as a technician and technical trend trader that you probably get frustrated with, right? If you're getting into a trend, it looks like it's starting to turn in your favor, and then immediately you buy into it, and then it flips right against you as soon as you're entered into your trade. Does anybody ever feel that way? As a market, you're just waiting for you to get in, and then it's going to try to shake you out right after that. We've all been there. Bottom line is we have to manage that psychology and say, let's look for methods that can filter out a lot of that fake out and get us on the true breakout. So I use a two-step approach. The first approach is what I call a setup pattern, which is where it looks like we're starting to break out. But then I look for the market or stock to prove it to me, and this is what I call a confirmation. So a confirmation means that we're actually getting a situation in which we're getting a follow-through. And I'm willing to give up just a little bit of that initial kickoff of a trend to avoid a lot of those whipsaws. We can't get rid of all of those fake outs, but we can certainly minimize that if you let a trend prove to you that it's working. So a setup is like a if you thought about a speed racer and they're sitting there with a red light and then it goes to a yellow light and then it goes green, kind of the opposite of most traffic signals. And so if it's going from red to yellow, it's saying, okay, we're getting ready for a potential step on the gas situation, but we're waiting for it to go green, and we don't want to rush in right there, or otherwise we might get, in a speed racing, you might get disqualified. In trading, you might get whipsawed out for a quick loss. So we want to minimize that, because that'll chip away at your confidence. That'll really be something that you'll find that will not only affect your consistency, but I think more importantly, it'll affect your trading psychology. We want to build up our confidence in trading, so we're going to look at the specific criteria here. So let's go to a specific one here with one of my favorite tools, one that I developed that's in MetaStock as part of my Big Trends toolkit. I call it acceleration bands. Some people told me I should have called it Headley bands, but bottom line is that I wanted to get across the point of what we're looking for as traders, especially as you not only go from stock or futures or forex trading, but as you move into options trading. You need speed of movement. Velocity is what we're after, because you'll do a lot better if you're. How many of you have ever bought an option where you bought an option, you were right on the stock, say you bought a call, you thought the stock was going to go up, the stock gradually went up, it was kind of a slow ride there, but over time it eventually went up, but from point A to point B, you ended up losing money on the trade because it didn't go up fast enough. Anybody ever had that happen in your option trades? Well, yeah, right, exactly. We've all had that happen at some point in our option trades, right? That's what frustrates a lot of people about buying options, and then they say, well, therefore they're going to go and sell options because they think it's rigged against them when they buy an option. No, it's not rigged against you. It's just that you didn't buy a trend that was accelerating, a trend that had speed of movement. We're going to look for trends that are more, kind of almost parabolic. So we talked about Tesla, where they're going to look like this, and they're going to look almost silly, how they're going to be going up at a faster and faster rate. And you're going to get worried about that. You're going to think, well, gee, how do I manage that trade? We'll show you how you manage that trade. But if you can get greater directional movement in shorter periods of time, obviously that's a huge gap in your favor that basically that trend piles on. So from this perspective, this is what we look for at Big Trends. Now, like a lot of you, I started trading with moving averages, but what I found was a couple of problems there. I had too many signals. I'm sure a lot of you deal with information overload, right? You feel like you got too much coming at you. The pipe of information, thanks to the internet, is level the playing field for individual investors more and more versus institutions. There's all this debate about high-frequency trading, and Michael Lewis just wrote that book, The Flash Boys, talking about how the high-frequency traders are getting too much of an edge. But bottom line is that's for microseconds. That's for, the big institutional players that are looking to scalp a penny on big positions over literally microseconds. And so the idea here is that that you're getting too many signals in moving averages. I find that you still have plenty of opportunity. High frequency trading doesn't worry me. We've still had great trends that we've seen up and down, but the best stocks, the best trend following candidates, the ones that are really starting to heat up, don't tend to come back to test those same moving averages. If they do keep giving you those tests, a lot of times they're just getting ready to go the other way. They're not getting off the liftoff pad. They're just going too slow. So when I was trading, I started trading in 1990. So now I'm my 24th or 25th year actually of trading. And so the bottom line is that, I looked at a lot of bands. I looked at Bollinger Bands. I looked at moving average envelopes. I looked at Bomar bands and other forms of, Keltner channels, a lot of different adaptive bands to try to sort of weed out a lot of the noise that was happening around the moving average. And then I kind of started customizing some ideas myself and came up with a concept that's a little different than any of those, called acceleration bands. like a Bollinger Band, it's trying to say most of the time it should trade in between there. About 95% of the time is a classic 2 deviation type of a band. But the difference here is I'm not just looking at volatility like Bollinger Bands are, I'm also looking at trend. So let's look at an example here. This is a prior chart of Google where we're looking at an upside breakout. Now, you can do this on any time frame. I did it on IBM earlier this week on a 15-minute chart for literally a day and a half trade. So basically it's one of those that, you can do it for day trades, you can do it for quick trades of a couple days, or even swing trades of a week. If I'm a swing trader, I would key you on an hourly chart. For you position traders looking out over the next 1 to 4 weeks, the daily chart works really well here. So what we have here is we have 2 different sets of bands. So in green, we've got the 20-day acceleration band. So I'm just going to put an AB for that. That's acceleration band. Okay, and in red, these are the Bollinger Bands, these red bands here. And that's a 20-bar Bollinger Band with 2 deviations. So you're very familiar probably with Bollinger Bands, and they're a useful tool. But you notice the difference here. Bollinger Bands will race to catch up if a move is moving outside of those bands. It's not supposed to be happening outside of those red 20-day Bollinger Bands. You can see when Google started to break out 1 and then 2 bars in a row outside of not just the Bollinger Band, but also the green acceleration band, that's where we got our signal right there at the second bar's close. So that's the proof, if you will, that it wasn't just 1 bar outside of the trend, but it was actually a confirmation bar outside of that trend as well. So what we're having happen there is now you're moving into the acceleration. In fact, you can often look at Bollinger Bands overlaid onto acceleration bands to tell you where you're getting what I call volatility expansion. Now, and this is where the price action is starting to get more and more trending. And so, you've seen, that at that point when you're starting to see these big trends, that's in this case for Google, it was at about, 550 on the stock. And you can see that it was breaking out there. And at that point, I'll typically start building my position. You don't have to plow everything in all at once. We'll talk about how you can actually add to a position in what I call a retest when we get to my next indicator I want to share with you today. But, this is the first kind of a launching point where you're getting off the launching pad. You've got a catalyst for movement. Notice this is happening in September. Their usual earnings period is mid-October. And remember, this coming week for you option traders, this coming Friday is the Good Friday holiday, so we will not trade on Friday. So Thursday will be the last trading day this coming week, and Google's going to report earnings after Wednesday's close this coming week. This is a prior chart, so we're not telling you what you should do with Google here, but we're saying, look, from 550, look at where the stock ran to. It ran all the way up to about 740. And obviously, you've got chances along the way to book profits. Now, I don't just use a move under the green acceleration band to get me out. You see, if you did, you get knocked out there. And then if you did that, you'd get back in a couple bars later. I used to do that in the 90s because we were a little cleaner in our trends. We've gotten a little bit more noise. So I use a trailing average here that basically, didn't plot it on this chart, but basically trailing up. And this one finally got driven out here below that trailing stop there at about 699. So you can see here that after that, look at what it did. It then traded to the bottom bands. Both the acceleration got close to the Bollinger in red, didn't quite get there. Then traded up to the top bands, but that's a trading range at that point. So I don't mess with trading range activity, even though you say, well, that's like a 100-point range. Well, guess what? Google's options are certainly priced for volatility at that point. But while they're running up from 550 to 740 without looking back, those are the kind of trends that are powerful. They move. That's the bulk of the move in the shortest period of time, and that's your real acceleration opportunity when we look at these type of acceleration points. So from your buy to your sell, even though it wouldn't catch the exact low or the exact high, you'd still be netting out about 150 points on Google in about just under 2 months. So, you're saying, okay, well, gee, you could then swing trade or even day trade against that. By the way, if you're a quick trader over a day or a week, for you day and swing traders, you're going to be better off if you line up your short-term charts on the intraday, like a 15-minute chart for the quick traders or an hourly chart for the swing traders. Line those up with your daily. If you get your buy signals happening with a daily buy signal, you're going to be a lot better off. So what you want to avoid is you don't want to avoid like an intraday chart showing you a short signal as it's having this little pullback back here, say in mid-October, and then it takes off again because the longer time frame, the daily, is showing you a powerful bull trend. Okay, so from this perspective, that's what we look for. Now, again, if the acceleration bands would encompass 95% of the price action, guess what? I want to trade the other rare events. That what should be the other 5%. It's actually more like between 10 and 15% of the time it happens for an individual stock. These are called the fat tails of the distribution because they're happening more frequently than what you would expect. And that's because you've seen it, that the supposed 100-year floods happening more than once every 100 years, right? The bear market of 2000, 2002, 50% haircut in the market happened again in 2007 and 8, right? From the peak to the valley. So, these are moves are happening bigger to the upside and bigger to the downside than you would expect. The key is that they're not expected. And that's what makes the options a great opportunity when you can ride an uptrend even after earnings, is you can get some great continuation move, what we call a catalyst move, after a good earnings report or a bad earnings report, and you'll see follow-on actions. You want to take advantage of that. So, we've talked about the acceleration bands, and you can see the acceleration bands on this chart of LVS, Las Vegas Sands, going back over time. Is you'll find windows where it's moved outside of there, like on this first signal back here. These buy signals are from MetaStock based on percent R. Now, you've probably heard of percent R or percent range. Larry Williams developed that indicator. I tweaked it based on testing that actually showed that if I made a little longer setting, it's still a pretty jagged line. It's kind of like an unsmooth stochastic for those of you that follow that oscillator. Is that if we go into overbought territory here, you would think when I say the word overbought, that's a bad thing, right? It's not. Not if the stock wants to keep going up. So when you get a signal like it's going overbought, and then guess what? It's not staying there at the top of the range. It's actually moving through that resistance. That tells you that institutions and bigger players want to buy that particular stock, and they're trying to get a position in it. And here's the retest I was talking about. If you're seeing that acceleration breakout, then maybe you get a partial position on. We'll talk about money management and trade allocation here in a minute. But basically, what I'll look for on this chart, you can also see we've got the CCI up here in the middle panel. But bottom line is that I look at a lot of different things. But what I look for is what I call a retest. A retest is where the percent R comes back under the overbought threshold. So that happened, for example, on this chart back on March 15th. Okay, so on that low, we say that's a new retest. That means that if it closes under that low, going forward, you're going to get knocked out of the trade. But if it does not close under that day's low when it retested, you stay with the trade. Look at how many retests it gave you to hop back on the wagon. There's the second one happening right before it starts to take off there. There's a third one happening later March, right as we're coming into this next low. And by the way, draw across your support, and you'll see that you might trade below it, but you don't close below it going forward. And then your fourth retest comes in right there. Even a fifth retest comes in the next month. Okay, so what this means is that market structure, if you're in an uptrend, what's the definition of an uptrend? Higher highs and higher lows. And all my settings are available in my Big Trends toolkit for MetaStock. So we're just kind of laying out the foundational principles here of how I trade. So, we want to see CCI overbought. We want to see percent R overbought. Look at that. The finally, about the sixth retest, is finally going to violate right after that. So there's your last resistance, and then you can see it's breaking down here at that next day's close, or the following bar's open. You're saying at that point, this trend is no longer in place. But how many times could you have hopped on that train when it was pulling into the next stopping point, but then it was continuing on up after that? It was continuing on to the destination. And let me ask you, how many times have you missed a breakout and then you've sat on the sidelines and said, oh, I'm a dummy, I missed that first breakout, I should have traded it many points ago, I can't possibly get in up here, it was breaking out at 22, now I can't get in, it's 25, now it's at 26, now it's at 28, and it goes in this move up to about $30, right? So you're missing tons of opportunities out there, folks, if you're not aware of how to hop back on these retest situations. And retests, for me, give me the lowest risk and highest reward opportunities. You'll see that if you're getting a retest back inside the acceleration bands, I'll usually use the upper band as my upside target for a bull trend. Lower band, if I'm on a sell signal, is a downside target if it's giving me a retest within the band. Sometimes you'll get a retest and it's right back at that band. You see the next move that happened here while it was breaking out on percent R and CCI It was not breaking out on the acceleration bands. So that's not going to be as good of a signal by definition. Even if you're waiting for the next retest and you say, okay, let's show you one that didn't work. If you say, well, fine, I'll wait for the retest, I get in on the retest, and then this one, guess what? It gaps against you. That would not be good. Now, bottom line is that, that's why we're going to talk trade allocation, because every once in a while you might get a gap against you. I wouldn't be leaning very hard on that move because that's a case where it never accelerated. But look at the last move here in particular, where this thing takes off in early September. You see it breaking out. Now, we might wait on this until the bands start to really go. So sometimes you can say, look, the bands are starting to finally go here even a few weeks later. And then you say, fine, I'll wait on the next retest after that band move. Well, look, you get it. On a quick one candle slam down there, it looks like a nasty looking candle, right? But that low in mid-October was a key support level. You could be buying there and saying, look, at $37, I know if it closes underneath there, I'm done. I got to go. But and you probably only put on a partial position. You wouldn't have to load all your position in at any one point here. But then look, it takes off from 37 to 55. Even if you're waiting for the 1 and 2 bars outside the acceleration band, that's right before it then gaps up and you see it moves to 55. Where's your final exit on this one? Just so you can follow it through. So, okay, well, if I'm still in this trade, you're saying, look, there's my last retest, and then 2 days later it has a slight violation underneath that at about $48.50. It's not saying that at that point you want to get short when it gives you an exit. It just means you want to get back to the sidelines, because now the structure is not clear. It's back in what I call a no man's land. There's a lot of periods that the market is very efficient and it just chops around. But we're trying to find these strong trends, right? So what about on the downside? Here's a prior case with Research in Motion, maker of the BlackBerry. Now ticker symbol BBRY, right? If you want to go back and study it. The bottom line is there's a couple of trends here, and the first one looks like it's setting up to be a really nice breakdown candidate under the lower band. Stock's trading at about $55. And it edges down over the next couple of weeks down to about maybe $51, $52. But then it starts to come back up, and when it gives us our retest, that retest high should have held right there, and you see what happens. It knocks us out the next day. So sometimes you'll see a situation where the trend was not as fast as what we anticipated. That doesn't mean you should give up on it, because look at what happens on the next signal. The second signal in this case is where the money is. You see that it breaks down a second time here. And a lot of you say, oh, you fooled me once, so you were flat on me. I thought you were going to go down. You didn't do much for me that last time. You're not going to fool me twice. That's where you're missing opportunities from a psychological perspective. So the bottom line is that, look, that signal's happening now at about $48. And you see it comes close to a retest right here in mid-May. Not technically one. It was very close, though, right back there. But then there's your next retest right back into that coming out of that oversold threshold. That high, if it gets taken out on a future close, we would get out of the trade. Doesn't happen. You see, even on this last one, even if you missed that entire move down into the last retest here at $26, you could get on that last one from 26 and trade it down quickly down to about 21 bucks. In about 4 days, it dropped almost 20%. So it's all percentages. That's how you have to think about the markets. You can see the final retest here. If we would book partial profits, trail our retest, and then you're going to get stopped out right here at about 27 there in mid-August. So these are all examples of the kind of technical prowess that you can develop with the right indicators. Now, like I said, you start making money with these indicators, then you start getting greedy, then you get in trouble. We got to manage your greed and your fear. And what I would say are the most costly 3 letters in both the trading language and the English language would be the first letter E, the second letter G, and the third letter O. Your ego, certainly mine, I've learned, will cost me money. That if you have a desire to be proven right, you're not going to be able to let go of a trade that's not doing what it's supposed to be doing. Let's face it, we just said at the beginning, we want to trade the right patterns. We want to trade the right market structure. If the structure is not right anymore, why are you still in the trade? Because you're hoping at that point that you can set yourself up for a comeback, and that's just a dangerous slope of hope. You're going to get yourself in trouble if you don't learn how to cut and run quickly on trades that are not doing what they're supposed to be doing. The desire to be proven right is so ingrained in all of us, from schooling, from prior jobs or existing jobs, where if you're not right, you're not going to have your job if you're consistently not right, right? If you make mistakes. But the bottom line is that in trading, good trading and good results can still be had, even taking quick losses, even not having a monster win percentage, as long as you take your losers quickly and let your winners run. You've got to remember that the last trade you made and the next trade you're going to make are not dependent on each other. A lot of people assume that, okay, well, therefore they just had a losing trade, so that means the next one's probably going to be a loser too. Or just had a winner, then assume the next one's going to be a winner. You can't make that assumption. Every new trade is a new event. It's a new point in time. So you're doing the right thing here because you've got a great group of educators, and you're really learning about trading the right way first with solid people who've traded for decades, and thus have sharing you the lessons learned to help speed your learning curve. I always ask myself, what's the worst that can happen? Okay, and if you say, well, if you say you're starting to trade a bunch of options and you get confident about that, you start loading too much into a position, well, if it gaps against you and you take a wipeout on an option trade and you've overcommitted your capital, that's a bad thing. So we want to make sure we manage that. We're going to talk about position sizing next. But what you'll find is that once you train yourself on the right indicators and approach to use, and then you learn to manage your risk first, then the gains can become a byproduct of following your plan over time. What you're going to find, what you have to get out of the psychology of is thinking about, what that move that day equated to in your real world in terms of, I could have bought a car with that. I could have made a mortgage payment with that. I could have done X, Y, or Z with that. That's all something that we want that money, but the bottom line is you have to follow the structure of the markets and let that be your guide. And then, so if you basically say, okay, if you can trust yourself to follow your indicators and follow your method and get in when you're supposed to get in, get out when you're supposed to get out, this is what good trading is about. It's building that internal trust in yourself. That's the confidence that you'll do the right thing in the heat of battle. What I always tell people about acceleration bands is that stocks and markets that boom up can also bust down. This is a prior chart with oil prices, USO. You saw back in the day, oil was surging to the upside, and we'd seen both in percent R and then acceleration bands.
Price.
Yeah, we saw that basically we had a situation in which you can really get a big move up when you're catching that correctly. Now, from this perspective, on the same way, when oil came back down, it collapsed. You see that we were getting a big sell on the way down below the bands. We've got our yellow trailing moving average in there to help tell us where that trend changes. But you can see that basically you're catching big moves in oil in both directions. So one of the lessons is do not fall in love with any stock or anything that you buy or sell. Don't get convinced that it's going to the moon forever or that it's going to zero forever. That basically you have to learn how to be objective and not fall in love with any particular stock symbol or market. So you look at an example like a past one here. We're looking at the big trends here, and then we can go and look for swing trades and day trades. I want to be on the right side of both the short-term rivers in time and the longer-term rivers in time. When those things combine with you, you're going to see that basically you'll get opportunities to really have a much more powerful river when you get 2 or 3 rivers of time flowing together. So we're talking big trends, and then you can tighten it up to your intraday time frames. So like, for example, we mentioned percent R. Percent R goes overbought, did it a couple times here, but you see the second time it happens, we're breaking out above that prior resistance. If it doesn't break out through there, you're not going to make that trade. But when it starts to move through there, if you were looking at a weekly chart, like here, you see it finally gave our signal to get into ISRG, the maker of the Da Vinci surgical robot. So that stock's done really well in the past based on these kind of moves. You're saying, look, that's where we're going to get the kind of leverage point. And look at how long a move can stay overbought. This is why you have to retrain yourself about, oh, well, overbought can't stay overbought. I should be selling an overbought market. No, you shouldn't. Not if it's going into a strong trend. You see you get a first retest kicking in here off of this low, and notice it traded below there the next bar, but then that candle did not close below there. So that's why I say it's got to close under that low. The next time it happens, look, it does the same kind of a pattern. You're kicking right into that same type of a low here, then you're holding it at the next bar's close. So basically you can catch a nice retest and pop it back to the upside. Of course, this one's going to finally end here, you see, once it starts to roll back under the acceleration bands as well. This is a 20-bar acceleration band in blue. That's my classic setting for the acceleration bands. We've got a longer-term Bollinger there in red. Just another way to see when it's breaking outside of some longer-term what should be resistance. Guess what? When the markets do something that they shouldn't be doing, that's where you have big opportunities. So my basic rules here on the acceleration band, like say for a bearish one, we'd be looking for it to close 2 closes in a row below that lower band. This is very counterintuitive, right? You'd think at that point it's 2 oversold. Guess what? If the institutions want out, they really want out and they can't get out all at once. So basically they'll keep on selling a really nasty breakdown situation because they know bad news is coming. So for the strongest trends, the second close is even lower than the low of the first bar. So, and then what we'll do, and I'll give you this little setting here as a little guide you can plug in, is use a 10-bar exponential moving average to trail. That's a nice little guide that you can use to track it along, and if it's not holding that on a closing basis, and that's the key word there, close below that, not intraday trade, close whatever time frame you use. If you use an hourly close, it's every hour's signal. So you go back and you look at past examples. This is we showed you Google on the upside. Look at Google on the downside. It's 1 and then 2 bars underneath that lower acceleration band, and it's testing right back up into the trailing, but it didn't close below it there. To close above it, actually, in this case, is what would get us out. It held that ever so slightly on that little bounce. That was a %R retest as well. And then the bottom started to fall out. This is early '08, just as an example. You can see we did get stopped out here eventually, back about this area. But again, on any kind of windfalls, I'll take windfall gaps and say thank you very much. If it's gapping, you should be scaling out a part of your profits along the way. Then it came back the other way. Got 1 and 2 closes above on the upside and managed a nice upside trade in April of '08, even in the midst of an evolving bear market. So you made some money on the upside there as well. Now, I promise you to talk about trade sizing, money management. You know, you get earnings, for example, as a catalyst for a trade. You've got a lot of earnings coming up here. One of my rules, and I'm going to walk you through it with the options strategy here, is buy an in-the-money option. In-the-money options are a lot more stable. A lot of you were saying on your goals you want greater consistency. So most people assume they should sell options. Well, the other strategy is you can buy an in-the-money option that has what we call a high delta, meaning it's going to move a lot more closer to point for point. Like if it's got a, say, even a 70 delta, it means the stock goes up $1, your option goes up 70 cents on that dollar. 70% of that move. That doesn't sound like as 100%, but it still gives you great leverage against the stock because you paid a lot less for the option and still create what we call a stock substitute position. Now, you know, we'll keep our stop loss on these option purchases usually initially around 30%. Because we want to give it room in case there's a little initial wiggle. But we're going to work quickly to typically get it up to break even. After we usually get about a 30% gain, we'll start booking partial profits and raising our stops to break even after we hit that 30% gain on our in-the-money strategies with our weekly options. And the key is because you have tools like %R, you can progressively trail your stops at each key retest, at each key inflection point. And so from that perspective, that's important. Now, I showed you like when Google gapped down there, we call that a windfall gain. If you get a windfall gain, it's going to open big in your favor. Take partial profits. Don't take the whole thing off necessarily, but we're big on at least taking some money off the table into windfalls because you want to then say, okay, if it does reverse, you've booked some profit. If it keeps going, you still have something on to keep running with. And here's the key on position sizing. I don't like to allocate more than 5 to 10% per trade of the capital I'm allocating to any new trade for a system. And that's just for any one system. If I'm trading the acceleration bands, let's just say you took a, you know, if you had $100,000 you're going to commit to trading, but say you had 10 different systems, you might be doing 10,000 into each pot. And then of that, doing no more than 10% of that 10,000 would be $1,000 per trade. Out of your total 100, that's only 1% of your portfolio. You know, if you're really diversifying across a few or more than a few good strategies, I say start with one and build. And start with, if you're starting with one, just start small and build up. That's really, really valuable. Now, you know, the financial crisis was actually really good for us. This is a prior, you can't even find this chart anymore, Lehman Brothers. But I show it to you to show you how good these plunges were in addition to how good the bull moves have been. So, it works on both sides. It's hard for people to believe that something can go oversold like Lehman. The first time Lehman went oversold and then confirmed here, you see it was back here at about 35 bucks. That first move down for Lehman, it got cut in half down to 15 and then stopped out the remainder of the position there at about 17 bucks for about a 50% loss in the stock. Guess what? For put options, much bigger potential than that. But even this last move, I managed to pop it as it broke down here for one and then two closes under the acceleration band here at about $7. You say $7, why would you buy a put at $7? The options are very expensive. I was buying the deeper in the money 10 puts, and that you say, why would I buy a 10 put? The stock's at 7, it can only go to 0. Well, guess what? It went to 0, and it went to 0 real quickly. That doesn't happen that often, but we did it with AIG, we did it with Fannie Mae, we did it with a few of the big financial names on the downside. And the key was those options were very expensive. If you bought at the money or out of the money, you really paid through the nose for them. You want to buy in the money to get rid of a lot of that time value and put more of your focus on the intrinsic value. So in a put example, say you were bearish on XYZ. If we think that XYZ is going to drop, the stock's at 56.60. Let's say I think it's going to $50. Obviously, if you're shorting the stock, you're going to have to tie up a bunch of margin money. We can save that by saying, what if we bought an option that's a 60 strike put option? And you see in this example, if we had to pay $470 for it, how much intrinsic value do we have here? If you buy a 60 put, you have a right to sell it at 60, and it's already trading down here at $56.60. That differential is $340, right? So $340 is what we call the intrinsic value. So that equals, in this case, about 72%, okay, is intrinsic. That means that if nothing happens, of course, that means the other 130 is what we call the time value. The 130 that's left over is about 28% time. If this thing never moved, you'd be risking 28% if it finished at the same level at expiration, right? So the point is that, if you're wrong, yes, you do have price risk, Han. That's right. But that's why we show you the retest to put your trade on at an ideal risk-reward entry point. So if you're wrong, you get out quickly, you keep your risk down, you move on. If it does go to 50 by the expiration, then in this case you can see you would have made money on the stock, and you say, well, gee, I would have made $660 on the stock. I'm only making $530 on the option. Yes, but you're only putting up $470. So before commissions, you're making over a double on your option. And so the bottom line is that, yes, it's all risk reward. Yes, we have price risk. That's why when you put the trade on, you've got to know you're putting it on at a relatively good level. Our basic rules for the stock substitute strategy is buy the options where they have at least 2/3 of the total premium is intrinsic value. So that's pretty easy to calculate. If we were buying, say, a Verizon call, say we were in December, we bought the Jan 30 calls, and the stock, the option was trading at 5 and the stock's trading at 34.10. Obviously, a right to buy at 30 on a 30 call, it's at 34.10, it's worth $4.10. If you have to pay 5 for it, well, you can see that that's about 82% intrinsic, and thus the remaining 90 cents out of the $5 is 18% time premium. That's probably going to show you a delta of 80% or more. I mentioned the financial crisis because of how good it was to us. Look at how this one was breaking down on Citigroup even before 2008. In basically the fall of 2007, Citigroup started to really plunge both on percent R and also on the acceleration bands 1 and 2 closes underneath there. And you say, well, gee, it was already down to about 34 bucks. Well, guess what? Just on that move, it went down to about 20 bucks. And you see, then it was a little bit slow as it ground down from there. So we really, the best part of it was the first breakdown on Citi on the downside. So, and the yellow line was what we shared with you earlier on the 10-bar exponential there, PN. Bottom line is that, okay, so more on options on the essential number 7, knowing option strategies. Rob mentioned as well weekly options. He uses them. I use them. It's one of my favorite tools because if you're going to swing trade or day trade, why would you buy more time than you need? But the key is you better buy the right option. You better buy the in the money if you're going to trade that. I know a lot of you talk about credit spreads and stuff, and I'm amazed at how people are doing credit spreads on really wild and woolly stocks. I think you get a lot more potential buying an in-the-money option than trying to sell an out-of-the-money option that has just a fixed return on it. You can have a theoretically unlimited return and gain on your option purchase if you know how to ride these big trends. So we can follow those weeklies, and they're available in a lot of names. We mentioned Tesla earlier. It's been really one of the best ones over the last year on the upside. Of course, a lot of you follow Apple. Google's been plenty volatile, Netflix, now some of these others like Facebook, FB, LinkedIn. We've had good success with Twitter even several times in the last couple of weeks on the downside. So there's tons of opportunities there in these weekly options. They only exist for 7 trading days, but if you know how to use them intelligently, you can really get a good bang for your buck. Now, I'm running a little short on time, so I'm just going to recap. We do a lot of big trends to show you edges. We share with you today the acceleration bands. We share with you our unique approach to Larry Williams' percent range or percent R indicator, but we factor in a lot of these other tools, the CCI Commodity Channel Index. The efficiency ratio is not something you're going to find anywhere else but on the Big Trends Toolkit, which you can learn more about here for MetaStock here in a minute. And then basically, so how does that work? The Big Trends Toolkit and MetaStock gives you a great opportunity here to learn all of these tools. And so that's what BTTK means Big Trends Toolkit. So you'll see it when you get into MetaStock and then you add on. It's one of the most popular add-ons and plugins that they have is our Big Trends Toolkit. You'll get the acceleration bands already coded. You'll get all these different systems for percent R and all the other tools that I haven't had time to go over today, but you'll learn all that through training materials you get as well with the guidebook. When you get the toolkit. Bottom line is that's how you can get all these things called out to you, and that's how I scan for new opportunities. As there's so many possible opportunities out there, you need to be able to find the best of the best. You need to filter a lot of the noise out in your trades. This one's showing you an efficiency trade even just underneath here on Amazon from the past, where it gave us a classic retest on Amazon after a nice little signal that had happened at about $40. It was giving another retest at about $68, and then it was blasting on up into the $73 range. So, even for those quick trades, even for finding those re-entry points, if you've been missing out on these big trends up and big trends down in the recent NASDAQ correction, bottom line is this will show you how to hop back on the wagon and get a piece of the trend, how to find an ideal risk-reward entry point. Yes, you still have a risk of getting stopped out, but if you're using options, if I get stopped out, it tends to happen quickly, and it keeps my losses smaller. When I'm right, it gets bigger wins, and I can ride them for longer periods of time. So you can ask MetaStock about how you can take advantage of the Big Trends Toolkit through their site. They can post a link about how you can find that. But I wanted to give you an extra bonus today, and that's a freebie DVD I'm going to give out that I'm just going to only ask that you pay a minimal shipping charge so I don't get to a losing situation on it. At least, I'm giving out the product, but I'm asking you to pay basically a $4.95 shipping charge wherever you may be. Very reasonable. It's just going to cover our shipping costs to get this free DVD out to you. I know I go pretty fast, and I feel like there's so much more I'd like to cover with you, but I'm only a few minutes away from needing to hand it over back to the good folks at MetaStock for the next presentation. The 7 Golden Rules for Option Trading Success is a DVD I did that I really went into a lot of the psychological problems other traders have and how you can get the better edge against most other traders psychologically. If you're finding that your emotions are tending to get the best of you, you're going to want to watch this. And so what I did is I set up a special web page here, which is just bigtrends.com/7 golden rules. And I'm going to paste it in here so you can see it. And so you can go to that link. And when you go to that link, you're going to see this web page pop up. And it walks you through, and you can look it up online. If you bought it online, you'd pay usually $50 or $60 for it. I think the retail is $60. I think you might be able to find it for $50. Guess what? For here, you're going to find it for just the cost of the shipping. It's no cost for the DVD. I'm just going to ask you to pay $4.95 for the shipping, and I'll send it right away to you. So the bottom line is it highlights the top 10 problems all traders face. I don't care what vehicle you're trading. It says option trading success. Guess what? It applies for every single type of trader. And it's going to show you how to overcome your emotions. So the bottom line is that you can really take advantage of this over my 25 years of trading now to weather every type of market, up, down, or sideways, and know how you can position yourself for success. So I've done that today for you with my compliments to say, hey, take advantage of that. Check it out at bigtrends.com/7 golden rules. The only problem is I only have about 300 of them still in the office. So bottom line is that I have to say while supplies last. We've got many more than that in the webinar today. So you're going to want to go to that page quickly and lock it in before they're gone. After they're gone, I'll have to say I'm sorry about it, but basically it's my way of saying thanks to MetaStock for allowing me to share with you some of the lessons I've learned over more than 2 decades of trading. So go to that page, bigtrends.com/7 golden rules, and you'll see you get the DVD for free with just the nominal $4.95 shipping charge. So I don't get hurt by it, but basically I'm going to blow up the inventory that I've got here because I guarantee you those few hundred will be gone quickly. Thanks so much for being with us. It's the same shipping cost even overseas. So I'm going to take a little loss on you overseas, folks. But basically, I want you to get this in your hands to allow you to see what you've been missing and go from there. So, my time is up. I want to say there's a lot more great speakers to come, though. So stay with us. I'll hand it back over to the good folks at MetaStock so they can carry on with our next session. And I hope you enjoyed it. Let them know what you liked, or if you have anything else you had questions on, you can always get us at our bigtrends.com website through 800 Big Trends, or client care at bigtrends.com is an email you can reach for any kind of questions on follow-up customer service. Back to you guys at MetaStock. Thanks so much for hosting this great event.
Worked very, very closely with Price. One of the first projects that that I worked on in this team, and I absolutely, in terms of like a market guru and a market expert and stuff like that, I've learned a lot about trading options from him, and definitely a recommendation if you're in the market for some really good option strategies. Price, top market timer, wrote several good books on it. So